Firstly, thank you very much to everyone who is attending. My name is Bex Pierce. I work over here at Goodman Masson as a divisional director of our accounting and finance practice. I'm delighted, and a huge thank you to Jennifer and Alistair who will be joining us today, and Paul Goodman who will be leading this fireside chat. There will be opportunity for questions at the end. If I can ask that everyone puts those, even as they kind of pop into your mind throughout this, into the chat. And then what I will do is, we've got some time, as I mentioned, at the end to answer. What I may well do is kind of amalgamate, if there's some common themes, is just try and wrap those up into several questions. And with that in mind, Paul, I shall pass over to you.
Good afternoon, everybody. I'm Paul Goodman. I'm the founder of Goodman Masson. Welcome to this afternoon's online seminar, The Business Exit Roadmap, Priming Your Business for a Sale. I'd like to begin by introducing our guests. Alistair Nisbet is Chief Executive of Natrium Capital and one of the foremost M&A advisors in the chemicals and materials sector. Over a distinguished 30-year career, Alistair's led transformative transactions across Europe, Asia and North America, and he's advised major global players such as BASF, Dow, INEOS and more. After heading the global chemicals M&A practice at Lazard, he founded Natrium. The Natrium team, with Alistair's deep strategic insight and deal execution experience, has to date overseen over 100 billion worth of deals. I'm also delighted to welcome Jennifer Madura Haywood. She brings decades of strategic and transactional leadership in the industrial sector, with particular emphasis on chemicals, paints and coatings. She led the strategy function at ICI, the strategy and M&A functions at Asco Nobel, and the strategy and communications functions at GKN. And she served as non-executive director at Oxia and was a trustee of the John Innes Centre. Prior to her corporate roles, Jennifer was a McKinsey consultant in the Cleveland office and later the London office. She's been on the Natrium team as managing director for over a year and a half now. We're going to begin by asking Jennifer and Alistair to set out some opening remarks. Then we're going to move on to some questions that are specifically set up for a finance audience before we have the Q&A. Jennifer, can I invite you to begin with your opening remarks, please?
Of course. Firstly, thank you very much for inviting me to be here. I'm very pleased about it. And secondly, I'm sorry, the computer keeps beeping. I don't know how to turn that off, but we're going to leave it for the minute. As you've already heard about from my CV, I've spent most of my career on the corporate side rather than the investment banking side. And as a good McKinsey consultant, I have 3 key learnings about M&A that I wanted to share that are therefore a bit more on the corporate side. My 3 key learnings are: number 1, be as clear as possible upfront about what you're selling and why you're selling it. Second, get the right team in place. Third, make sure you're looking after your people. A bit more detail about each of these. First, with regard to be as clear as possible upfront about what you're selling and why. In many of the sales situations that I've worked on, we were selling a part of an existing business or a carve out of an existing business rather than the full business. In these cases, it is really important to be clear on what the boundaries are between the business being sold and the business. Which site will be involved? Will you be selling the full site or just part of the site? Do you expect to still be involved with a business or for sale as a customer or supplier? The earlier you can be clear on these things, the better as it will have an impact on the process you'll need to follow and the people you'll need to involve. It also helps to have a shared understanding about why you're selling the business. It helps to have a reasonable internal company consensus on the true reasons for divestment, as this can also determine how best to structure the divestment process and also think about who might be potential buyers of the business. Specifically, it helps to have an ingoing shared understanding of things like urgency, floor price, boundaries, as I mentioned earlier, and whether there are one or more obvious natural owners for the business, which could be likely buyers for the business. Second point, get the right team in place. The first question you might be asking yourself in terms of the team is whether you'll need an advisor. Given who I now work for, you won't be surprised to hear me say that you probably do, but I would have said this before I signed on at Natrium. The main reasons for this are that divestments are very resource intensive. Even in the largest company, there's rarely the type and number of people resourced needed. Second, if you give your advisors a clear brief on what you're selling and why, advisors will provide you with very valuable process and valuation expertise. And last, but definitely not least, provided you choose the correct advisor for your company, they should also have a really good network of potential buyers. Because good advisors should be able to identify and provide an entree to potential buyers, this is one of the first things to look for in terms of potential advisors. The other two things I would look for are somewhat less tangible. First, I'd look for someone who will tell you the bad news and give you good advice about what to do about it, rather than someone who sugarcoats things. Second, as this will be a team effort, you should look for someone you can work with far into the night. With that in mind, if or when you do have a competitive bid process for the advisory role, I would definitely recommend that you meet the people who actually work on the project and that you understand how much day-to-day senior involvement there will be. You will, of course, need lots of internal support on all the major business functions. You may also eventually need additional external support. This is something you can work out later. And assuming you do use an advisor, they should give you good advice about this as well. Third major point, make sure you're looking after your people. Divestment processes are very people resource intensive, and divestments take much more time, both in terms of working hours and the calendar, effort, and stress than you think they will. With this in mind, you really need to look after your people during the process. There are some things people-wise that you should think of as part of the sale process itself. For example, who are you expecting to divest people-wise with the business? Of these, who's fundamental to the sale process? How are you incentivizing these people? Similarly, if you're looking at a partial divestiture, who are you expecting to remain after the divestment? Of these, who's fundamental and how are you incentivizing them? But more broadly, you need to think about how normal business will carry on during the process. In many cases, people who are working on divestments work all day on the divestment and then have to do the real job after 6 p.m. Furthermore, as divestments are very unsettling to the organization at large, you need to think about how, when, and what you will be communicating to the people more broadly in your organization. So that's my 3 points. Number one, be very clear about what you're selling and why you're selling it. Second thing, get the right team in place. And third point, again, last but not least, look after the people involved.
Great. Thank you, Jennifer. Alistair, should we hand over to you?
Yeah, thank you. Thank you, Paul, and thank you, Jennifer. I'd like to just describe the process first. There are 3 phases that I see of an M&A process: preparation, disclosure, and negotiation. So let's take them in turn. The preparation, Jennifer's already said, get the scope right and of the business, and then you need to describe it financially, operationally, and legally. And when you've got that, you can then launch the process and approach different people. In terms of the disclosure, there are some key stages or documents. The first is a teaser, which is just a single page, doesn't need an NDA, which you try to get people interested in what you're selling. The second, and there are a lot of 3-letter acronyms, is the confidential information memorandum that is colloquially known now as the SIM. Some people say the IM or the SIM. The management presentation, when we've got a select few bidders, after people have said this is what we're interested in, this is what we'll pay, we then have a management presentation for perhaps half a day to a day about the business, looking at its real detail. We also encourage the development of the writing by external advisors of what are known as vendor due diligence or vendor assist reports, which help to summarize the business in detail, but also uncover potential issues with the business before we go in front of potential buyers. There's the virtual data room, which is another TLA, the VDR. We do site visits if we need those, if it's a manufacturing business or a distribution. And we have a Q&A process. And those are usually done through the data room. And I've seen as many as 500 questions per bidder for certain projects, which is a lot of questions. So you need to be ready and efficient in the way you manage those. Negotiation, well, that's just what it says on the tin. I've described the process now. Now I'd like to just make a few points of things to think about. The first, we've already alluded to it, both Jennifer and me, keep it simple. There is a price for most businesses, but often there is a premium for simplicity. The second, think two down. This is a military term, but in M&A means help to write the reports for the buyer's board of directors or investment committees. Think, what do I need to convince people to buy this company? And those are the type of documents and the way we phrase issues and opportunities for the buyers literally to cut and paste them into their own materials. Number three is consider the business as a standalone company. Don't carve lots of things out and say, well, yes, the buyers might need it. They want to know what is a genuine standalone, because they may need a few extra costs themselves to be able to accommodate it. If it's a private equity firm, they will obviously only take it as a standalone business. 4, get the numbers right. Get the historic numbers right, the monthly numbers that are historic as well. Make sure the budget is right and have a realistic long-term forecast for the business. 5, be open and make sure your team is open. You're unlikely to be able to hide anything from buyers, so don't try. Get any bad news to you first and then get it out to the buyers as soon as possible. And don't try to cover things up. They will only end in the destruction of value later. 6, most deals have a wobble. Don't worry, this is normal. Work through the problem, find a solution, and share it with the last buyer or the potential buyers as you're going through. And finally, everything takes longer than you expect. How many times have I heard CFOs complain, my CEO has asked, haven't you sold the business yet? Don't they understand the process? It takes much longer. Paul, I think that's my summary. Over to you.
Thank you very much, Alistair, and thank you, Jennifer. So let's begin with some of the questions that we've talked about. Jennifer, can I invite you to deal with this one first? What are the challenges of the Chief Financial Officer and the team in preparing an organisation for a potential deal?
Well, so the answer to this depends a bit on the role of the CFO in M&A work in an individual company. I have seen companies where the CFO, where the actual M&A function reports to the CFO. I've seen companies where the M&A function reports to the strategy function or directly to the CEO or possibly even to the general counsel. I have worked in a company where that happened as well. So if assuming that the CFO is not in charge, because if the CFO is in charge more broadly, then basically all of the challenges you're going to hear about are CFO, cover the CFO, but also the rest of the organization. If you're focusing on what specifically CFOs do more than any other person in the deal process, the answer has got to be financials. And that's about creating a clear, agreed upon, supported set of numbers that people can get behind, talk about, etc. So that's the most important role of the CFO. But of course, given the 3 points that I gave in the beginning, all of the other things are important. So it is important that the CFO act as part of the management team in terms of making sure that the scope is clear and that people are looked after, etc. But most importantly, numbers, numbers, numbers.
Alistair.
Yeah. So picking up on that, I think what is really important is to make the management team of the business you're selling buy into the numbers. And there's a general tension between the CFO, who's trying to, or perhaps it's the CEO, trying to get the forecast to be as big as they possibly can and the expectations. To the other issue is what will be delivered. So in many ways, the budget that unfolds during the year has to be delivered, because if it isn't delivered by the business, then it can begin to undermine the process and definitely undermine the value. So that is really important, to get the management to buy into it and also try to find a balance that is realistic. The final thing is that depending on the type of financing, it's important to have monthly data for the business, both of the P&L account, but also balance sheet data. You can't get an asset-backed loan, for instance, without having at least a year of monthly data. If the division exists, then generally you've got that in your internal files. If it doesn't exist and it's a subdivision, then those need to be created. And that's where it's a real tough decision and tough process to get that right. And finally, help the management team with their work, because as Jennifer said, if they're working from 6 p.m. onwards on actually running the business, it can often, its performance can begin to tail off as they spend hours working on the M&A process. So helping them and giving them support to keep the business running is also important.
Would you say there's a single most underestimated challenge that a chief financial officer will face? Jennifer, do you want to pick up on that?
I think this is pretty easy because I've already implicitly answered this question, and it's the same for everyone involved, including CFO, sorry. The biggest underestimated challenge is just getting through the process with everyone in one piece, physically and mentally, as really divestment processes always involve way more time, effort, and stress than people think they will. One more thing about this that I haven't already said: all of this applies virtually regardless of the size of the transaction. So transactions aren't particularly scalable. You have to go through more or less the same steps for a small deal as you do with a big one. Alistair's already referred to the only thing you can do to reduce the amount of time and effort, which is to reduce the complexity of the carve out. Lastly, I know this isn't a focus of our discussion today because this is about the exit roadmap, but if you're ever on the buy side, I would say the biggest underestimated challenge is in dealing with cultural differences after the sale has gone through and creating a truly best of both worlds integrated combined business. That's really difficult to do.
And Jennifer, when you said that's really difficult to do, what are the big challenges with that?
Well, I think one of the biggest challenges is actually knowing your own self, meaning companies tend to assume that their culture is normal culture and other people's culture isn't. And although I spent my part of my life working on quote unquote M&A transactions, that's merger transactions, which I've virtually never done, acquisition transactions, which I've done a number of, but I've also done a lot of divestments. And generally speaking, in the divestment case, somebody buys somebody else, and they presume that the culture of the people that their culture is quote unquote the right culture, and the culture that they're buying isn't necessarily so much the right culture. Otherwise, why would they have sold the business, et cetera, et cetera? And so therefore, people come at it with the idea that they need to adjust to us. Whereas actually, if you want to get the best of both worlds, both sides need to adjust to a new combined entity.
And Alistair, from your perspective as an investment banker, Where do you see the biggest underestimated challenge for a CFO coming from?
I think part of this depends on size. If the business is smaller than the main operation, and it's a relatively small business, you have to recognize the CFO. You may not know it very well unless you actually ran it at some stage in your career before. So often the big challenge is there are things in that business that you don't know about, and maybe in general the business doesn't know about. So actually making sure that you have a way of learning about it is important, which is one of the reasons why we do recommend things like vendor due diligence reports, because they are a way of helping to uncover some of the potential issues that might be around within the business. So I certainly recommend those. Financial is obviously an important one, but also legal and the other elements that you have within those.
So I think we'll definitely come back to this question of vendor due diligence reports later. But Alistair, I picked up on something you said a little earlier. You touched on stopping people from destroying value during the course of a deal. So how do you respond to that? People just, what do you mean by that, first of all? People destroying value, and how do you respond to it?
Yeah, so let me give you some examples of questions I'm asked, and all of these, yes, do destroy value. Well, one is, do you think we can sell the business without a management team? And the answer is yes, but it really helps if that business does have a management team. And the sort of sub-question is, do you think it matters that the management team has a right to go back to the parent? Because the answer is yes, it does matter, because you want a group of people who firstly understand the business and then can sell the business, but also for a number of buyers, they may not have the management resources themselves to be able to take this forward. So a management team is the first thing that is that I would say is critical. Do you think we could keep some of the business? And the answer is yes, but at a cost, because you have simplicity. So we are involved in the chemical industry, manufacturing. And so there are a number of times I've been asked that somebody wants to retain a certain range of products that are produced by the site, but they want to do it. So we then have to work with supply agreements to ensure that they get a reasonable margin for their business, as well as the selling entity. We have to explain, obviously, that margin is shared, so the profitability of the business we're selling is also reduced and the total valuation is reduced. So that's the next thing is, yes, they can do, but if we just sold the business without that, it would make things easier and we would get a much better potential valuation. Another one, Jennifer alluded to this, is, do you think we can have a carve out on 3 or 4 different sites? So there's a little bit on each site related to the business you're selling. The answer is yes, but it is much easier if there is a way of consolidating it in a smaller area, then it is much better to do that. Another area is around carving out sales. So we have a situation at the moment where people are selling a sales force, and we're selling a related business using the same sales force. So the buyer will have to recreate that sales force rather than carve it, because they won't have the resources, and the resources are there to actually sell the business, sell the products, that is. And finally, probably the biggest and most damaging is not getting the numbers right. And so it's amazing how many times we have numbers and then gradually over time it becomes clear that the forecasts for the current year are not going to be met. As you're getting towards the end of any financial year, obviously that crystallizes these numbers and you know whether your forecasts have been good or not. That then undermines your credibility if you fail them. The worst case I've seen recently is there's a business being sold where the information memorandum, the SIM I mentioned, had a forecast of $150 million. Just after they'd received the initial offers from potential buyers, they then went back to them, sorry, the business has deteriorated. The 150 is the same, it's just minus 150 now. And so the business had actually deteriorated by 300 million in the space of 3 or 4 months. And that probably is that the business was already underperforming for some time. And what happens, as most of you financial people will know, is people say, no, our forecast's the same, but you gradually see the monthly figures later in the year getting higher and higher. And there's a certain point where you have to say, have you ever actually achieved any of those monthly numbers in any previous month? And when the answer to that is no, you know there's a forecast that's there. And finally, surprising number of times, it's really important to keep the plants running. And we're finding in difficult times, at the moment, difficult economy and strikes and what have you, all of these things can affect the performance of the business. So it physically isn't running as efficiently as it used to be. I think that's a good long list, Paul.
Yeah, thank you, Alistair. And just some of the things you talked about sounded like they spring from perhaps more human behaviour than the technical aspects of the deal. And from those points of view of human behaviour, what do you come across? Is it greed? Is it naivety? Is it opportunism, stupidity? What are those human behaviour points that you're having to deal with?
I think the first thing that you to not answer your question immediately is one of the things that you need to assess is what type of a business are you selling and how strong do you think the auction is? If you've got an auction where you have an absolute must-want business with 30 people knocking down the door, you can get away with lots of things and you can play the tough guy and you can get people to do something. Usually the type of businesses that we get are the problem businesses, which take a little bit more hard work. And so if you try to be the tough guy, we're not going to disclose things, we're not going to give them, take it as it is, you tend to destroy value more. So I think what we find is in many ways, there are two different types of negotiators. You've got the negotiator who is very much a cooperative negotiator on the one hand, and there's the other negotiator that is very transactional, take it or leave it, and so on. And what we find is the ones that are prepared to work the process, people have read the book Getting to Yes, we find that approach with buyers, with businesses with only a limited number of buyers, is a much better way that you work the problems and the challenges. Because one of the issues that you get with this is it, as a business is underperforming, it also undermines the buyer who is telling it to his board, this is a business of X, when they have to go back and say, well, sorry, it's X minus. And the same story is with the banks who are providing financing, and they're saying, well, is that really that? So in terms of characters, I think at the end of the day, it starts with honesty of how strong your auction is. And then the people that play the tough guy usually can only sell those really attractive businesses. If you want some of the businesses that we're dealing with, you need to be a lot more, work a lot more with the potential buyers of the businesses.
Thanks, Alistair. And Jennifer, you're looking at your experience means you can look at this from the other side of this question from the other side of the fence. And what's your experience been of how people have ended up fighting people to stop them from destroying value?
Well, so the experience from the other side of the table is that, you know, as Alistair described a bit earlier, what I would have to do as the head of, you know, strategy and M&A is be preparing documents internally that say, this is what we think the business is worth, this is why we think it's worth it, this is why we think the business is good, this is what you know, these are the cons of the business. So we're preparing that all internally. The more the target changes, the less and less respect you get from the inside the boardroom, and the more people are likely to think that there's something dodgy going on here, and that they're just being told all the good story and not any of the bad story. So I would say the better preparation, the better you prepare, the better you know what's going on before you do it. You don't jump into things in terms of trying to sell something. And furthermore, the more simple you keep it, Alistair's made that point, that's a lot easier. The less adjustments you end up with, all of that is better too. But the last thing I would say, having also being on the other side of selling the businesses, I would say is, I think that most of what happens that goes wrong is frankly as simple as lack of communication that leads people to making mistakes. And part of that is about people not wanting to communicate unpleasant things. It's about people not being brave enough, not being courageous enough, not being, and then what happens is, as Alistair also mentioned earlier, sooner or later it all is going to come out. So the important thing is creating a culture that encourages people to say that the emperor has no clothes, rather than to encourage people to go around saying how nice the clothes look. Because sooner or later it's going to fall apart. These processes last too long and have too many people involved for people to not find out about all the negatives eventually.
Thank you, Jennifer. Alistair, you've touched on this question a couple of times of vendor reports. So first of all, what vendor, just to begin with, what vendor reports would you recommend?
Okay, so let me clarify what they are. So usually they are reports that cover the areas that banks need for their due diligence to provide financing, and they're the reports that many businesses also need. The first one is most important for this group is the financial report, and that's usually prepared by an accounting firm. Some people prefer that it isn't their auditor and they choose a different one. Some prefer to use their auditor, but it will be a different team within the auditing group who will look at the business. You have two different types, which is either a vendor assist, which uncovers all the problems, lays out the business as clearly as you can. And then there is the vendor due diligence, which is the vendor VDD report, which is actually assignable to the new buyer. Those obviously are more expensive because they have to be assigned to the buyer and they have to take them on. Are they any different? Perhaps they're slightly more detailed in the level of due diligence that they do between them. They certainly charge a lot more. Many buyers want to do some of those things themselves, but what it does is it means that all of the bidders at a certain point have a good amount of information, and so you get over the hurdle that some people want to wait until they are the last person standing before they do these reports. You provide them with them in a pretty comprehensive way. The other reports are legal, looking at contracts, looking at ownership of sites, of assets, etc. And that is also important, usually prepared by your lawyer. Those are often slightly more slightly smaller, but really very important to do. What people are obviously particularly interested in is whether there are any change of control clauses that exist, but there are lots of other legal potential issues that you may have, which are brought out and clearly stated by the legal team. The third, and particularly for manufacturing, is an environmental report that looks at the issues on each of the sites. And obviously, if you're a business that's international, you need people that can speak Polish or Italian or Spanish or whatever, because most of the permits and the other things are absolutely in those local languages. They're all brought together in one report, and they can be quite comprehensive. We use the data that they've done, and we put that in the virtual data room as well. And then the final is, sometimes people also want to see a commercial report looking at the potential for the market, that the products are being sold, that the business is selling, or maybe it's a new technology, a new IT opportunity, looking at what that potential market is. Many banks want to see that commercial report. Strategic buyers don't always need a commercial report because they're already in the same market. So it's really those four. What we always do as well is say, any reports that you have and need for your report, any documents, request them, and then we've also put those in the data room as well, so that they are able, that the buyers can cross-reference the vendor reports with the actual documents in the data room.
So, Jennifer, from your experience on the other side of the fence, vendor reports must be creating a big workload.
Well, yes and no. I mean, they do, obviously, it's like getting your taxes done by an expert. The expert doesn't go out and get all of the forms that that has to be brought together. But generally speaking, in most normal companies, they do have some relatively advanced forms of let's say, filing systems to be able to locate the information that's needed. But what I would say is that what you need to do is make sure that you're getting your money's worth for these reports, meaning that they're really good quality and will actually help you market your business. And one of the good things that investment banks can do that corporates are not generally as knowledgeable about is know who is good to hire for various of these reports, because it does matter, for example, what experience in the industry these companies might have, and it also matters what geographies they're normally working in. So if you're in a slightly odd geography, like a project in Africa, for example, then you probably want a different kind of a different set of external advisors. So I think that it does require a lot of work internally, but a lot of this is helped by choosing the right people to do it. And I think your M&A advisor should be able to help you make good choices about that, both about what you need and who you might use to do it.
If I could jump in and say, yes, they take a lot of time to do and prepare, but at least you only do it once. And so that information is that you don't have to repeat that for all of the bidders that are in the process. So that's the advantage, is yes, they take time to prepare, but they save time during the process, and they keep and maintain momentum in the process because people get up to speed very quickly.
Thank you. And so moving on to the next question, EBITDA adjustments and normalization. I suppose, to put it in rather broad terms, what do you think should be done? Yeah. Alistair, we'll start with you.
Yeah. So we often look at a business, and often they are reported down to gross profit plus a few extra costs, but we don't always see a business all the way down to the operating profit. And one of the things when you carve out a business is you want to know what those are. Now, if they are included centrally, one option is to ignore them altogether and only present the business down to gross profit. This really proves a problem. And so it's important to find a way of allocating those costs for the standard SG&A into the business as though it's a standalone entity. Sometimes those are already included within a factory or a series of factories in a division. And then there are some extra ones that are carried about centrally, such as HR or purchasing or legal or whatever. We at least need to know what those costs are, because many of the buyers will save some of them, but not all of them. Any private equity firm will want them very much there. So the other thing that you can strip out, though, is any central senior management costs that would genuinely not be there when a business is sold. So the CEO, CFO, whatever, those type of costs, that the genuine, if I call them headquarter costs rather than operational costs, those can be stripped out of a business and presented as a standalone. Where it's also, there are some question marks is where businesses may be sold, how you adjust for some of the costs in the history and so on. And that's usually where the discussion with the accountants is very, very helpful. So the answer simply is not as much as you would like, but often make sure that you have, if you do only report the business to sort of gross profit plus, then at least have a clear view of what the allocations are for the business that would be defined as a standalone.
And Jennifer, from the point of view of some of your previous experience, you would have been looking for what you might term favourable adjustments, and I presume.
Yeah, it was so. I think I mentioned this earlier, but the simpler you can make these things, the better, right? Somebody has got to present this to the board, and the more adjustments the selling organization makes, the less likely the buying organizations will believe in these adjustments. And so what you would prefer to see is a complete statement of what the business would actually do on a standalone basis. And then that allows each individual company who's going to be buying, whether that's a private equity company that would have it as a completely standalone, or a corporate where you might definitely be looking for synergies. But you definitely wanted the numbers to be as reliable as possible, as simple as possible, as few explanations as possible, so that you can do your own internal analysis of what you think you can get in terms of synergies on the cost side.
And then before we start thinking about Q&A, just one further question. So what's out of what we've already discussed, what's the one big takeaway that you might both offer? Jennifer, do you want to start on that one?
Yeah, well, I said it at the beginning. I'm a former McKinsey person. We always have 3 takeaways and we always start and finish with the same one. So I'm going to just go with that. The first one is know what you're selling and why you're selling it, and make sure there's good internal communications about that. The second one is get the right team in place, and that means the right external advisors, but also the right people internally. And the third one, look after your people, particularly the people working on the projects where, burnout is a real risk, but also the people more broadly in the organization who will be unsettled by this, even if it doesn't affect their day-to-day life. So, yeah, that's what I would say.
And Alistair?
I've got 3 too, but mine are simpler. Prepare, prepare, and prepare.
Okay. That's very location, Alistair. Fine. So, and just one very brief thing from me. You've obviously put yourselves as a team, put yourselves together as a team, with Alistair coming from a investment banking background and Jennifer coming from a corporate background. That must create some very interesting debates between the two of you. Can you highlight anything that's been particularly interesting?
Do you want to take that first, Alistair?
Well, I think what we do as Natrium, if you look at our logo at the top there, you can just about see there's an Na plus, and Natrium is Latin for sodium, and obviously that's why you have NaCl, and it is the fact that we as an organization are full of people who try to straddle both the corporate and the knowledge of our industry, which is the chemical industry, and the banking side. So we find that there isn't so much conflict with it. I think I think I probably disagree more with politicians actually and how they're damaging both our businesses than I do between business at the moment and the bankers that are trying to create and do M&A amongst them.
Jennifer.
So I don't think we do have many disagreements. So Alistair and I have known each other for over 20 years. Actually, interestingly, we've never done a deal together until I joined Natrium. But there's a reason why I chose to join this firm, which is I think it's a firm that is full of integrity and understands the client's business really well. So I'm probably making Alistair blush at the moment, but I wouldn't have chosen to join just any investment bank because I don't think that they would have necessarily had the same level of integrity and knowledge of the industry.
I can even see from here that he's gone red.
It's very kind. What I would say is that there are two different groups of investment bankers. There are people like us who are specialists in an industry, and we have strengths as a result of that. There are some who are more generalists, and they have strengths by being generalists, but they aren't as invested in the individual industry that we happen to be serving. And I think you do see different advisors, and you need to choose amongst yourselves of whether you want a specialist or somebody that's got a broader picture.
And right on cue, Bex, I think we are ready for some questions from those who've been listening.
So thank you to everyone. I know we won't get the opportunity to answer them all, but one of the first ones, and I suppose it comes back to what Jennifer was just saying around looking after the people actually. So what measures can be taken to insulate the wider business from inevitable distractions during a sale process to ensure continuity and resilience even if the transaction does not complete?
Right, so you want me to start with me on that? Yeah, well, so the answer is communicate. And I think there is a feeling that somehow M&A is this super confidential thing, and we can't tell people stuff. But there's a lot of things you can tell. You can tell that we value them as individuals and that we value the work we're doing, and this is, if you're buying the business, it's part of making the business bigger. If you're selling the business, it's possibly about getting a better natural owner for the business that's more likely to invest long-term in the business itself. So there is always a good story that you can tell. And I find that people who don't communicate, again, I think that's just an excuse. I don't, the confidentiality bit is an excuse. I think in general, communicate, to paraphrase what Alistair said earlier.
I have two very specific helps. One is to appoint somebody who's an internal coordinator for a process, because I think if you've got that, they can at least take some pressure off the senior management team within a division. So having a coordinator who can help manage, work with the other advisors, and also help, particularly in things like the question and answer, so it's directed to the right people, and is maybe they can already provide written answers to be checked, rather than many people facing a blank sheet of paper. So there's a lot that an internal person, or maybe a couple of people, can do. The second is incentivize people by giving them a transaction bonus. To answer the next question, which is how big are those? Typically, they're between half and 1 times somebody's annual salary. I have seen more, which are related to the actual value that's got, or their performance. So it is quite a lot, but if you put that in the context of the top 5 people in a business, in the overall scheme of the advisors that you have, it's money extremely well spent, and justifies the fact, as Jennifer said, they have to keep running the business after 6 p.m.
Thank you both. And particularly because we have CFOs on this call, one of the questions is, do you notice that the CFO more often not becomes an informal project leader, and therefore is often getting squeezed in every direction? Is there any advice?
Well, my biggest advice was you should appoint an internal project leader. If it is the CFO, then you need to hire an interim CFO to take over his day, or her, sorry, I should have said her. But so you need to hire somebody on an interim basis, or put in somebody internally who can take over some of the role of doing it. But generally speaking, we would always have somebody who is a project leader, who is generally speaking removed from their day-to-day job to do the work. And that person would, it could be the CFO, but it could also be somebody, it could be a business general manager, it could be somebody in the general counsel's office, it could be all sorts of different kinds of profiles of people. So I think the answer is, who's ever in charge should probably be doing nothing but the deal, and not be doing 2 jobs at once, because they're probably, jack of all trades, master.
Yeah.
The business itself, if we're selling a reasonable sized business, should have its own management team. So a CEO, but also importantly a CFO. And so they should be taking the first pass on forecasts of number development, preparation, etc., which should be overseen by the group CEO. If obviously you are selling the whole business, then but most of those will be aligned, but obviously that's a direct pressure on you if it's your business you're selling.
Okay, great. And we've probably got the opportunity for one more question, and apologies to those who we haven't had the opportunity to ask. What are some of the key non-financial metrics that buyers typically focus on, e.g. net promotion scores, employee engagement, or any others?
Alistair, you want to take that one first?
I'm not sure I understand the question. I mean, at the end of the day,
business metrics, I think. Is there any particular business metrics, Alistair, that you might particularly look at after you've looked at kind of the financials?
Well, generally what we're looking at is the performance, the products, and so on. So in many ways, we almost start with the commercial description of the business, of the products, of the markets, and the financials fit into that rather than the other way around.
Okay. Jennifer, anything to add?
I would say that most businesses who are in the buying, so what you need to, like anything else, you are selling a product, you're selling this business. So if you're selling the business, you need to think about what the buyer would want. And buyers want what normal business general managers want, which is a good business that's well managed, that has good operations, you know, all of these kind of things. So I think all of that is equally important. And I would also say that in today's day and age, looking forward, they're also looking for businesses who at least are very organized on the sustainability front. So in terms of their environmental impact, energy use, etc.
Excellent. Thank you. Thank you, Jennifer. Paul, shall I pass back over to you?
Yes, so really just a question of thanking people and wrapping up from here. Alistair, Jennifer, thank you both so much. I think I speak for everyone saying you've been incredibly engaging and really interesting and enlightening, and I think we all appreciate it greatly. So if you want to sit by your screens and clap, feel free to do so. I'll assume it's a standing ovation.
Thank you, Jack. Paul.
And also my thanks to you, Bex, and the people in the background who've made sure this is all run incredibly, what appears to me to be seamlessly. I think I would probably refrain from naming anybody in case I forget anybody, but you know who you are, and thank you very much. And I wish everybody a good day. Thank you very much.
Great.
Thank
Thank you very much.
Our pleasure.